Level 1, overdraft and negative balance. Your account is below zero, maybe by $4, maybe by $400. The exact number barely matters because the system reacting to it doesn't scale with the size of the problem. It simply activates. Within hours, an overdraft fee is applied, typically $35 at most banks. Some institutions charge this fee per transaction. That means if three small payments go through while your balance is negative, you're suddenly facing $105 in fees on top of the original deficit. The math behind this is almost precise in how it penalizes the wrong situation. If you had money, you wouldn't be overdrawn. But because you don't, the system ensures you now have even less. You try to use your debit card at a gas station. It gets declined, you try again, declined again. There's a line forming behind you. You're doing quick calculations in your head, trying to figure out whether a transfer cleared or not. But you can't process it fast enough, and the card still won't work. This is what financial stress actually looks like. Not dramatic, not cinematic. Just a card declining in public while you try to understand your own balance. The bank may offer overdraft protection. In practice, this means instead of declining the transaction, they approve it and charge you a fee for doing so. Essentially, you're paying to avoid that moment of embarrassment. Some banks have reduced or removed these fees due to regulatory pressure, but many still rely on them. And they are used most heavily by the people who can least afford them. In a recent year, banks collected billions in overdraft fees, much of it coming from a small group of accounts that were repeatedly overdrawn, the same individuals paying again and again for being stuck in a system that charges them for not having enough money. At this level, access is limited. You're unlikely to qualify for a credit card. Loans are out of reach. There's no flexibility, no personalized help. Everything is automated. The system doesn't know your situation. It doesn't know your paycheck was delayed or that a forgotten subscription caused the issue. It only recognizes one thing: your balance is negative. And from that single data point, every consequence follows. You are not treated as a customer here. You are treated as a risk the bank is managing. Level 2, low balance. You've managed to bring your account back above zero. Now you might have $200, sometimes $400, maybe $600, until rent or bills pull it down again. You're no longer overdrawn, but you're still in a fragile position. At this stage, the monthly maintenance fee appears, around $12 to $15 automatically deducted because your balance doesn't meet the minimum requirement. That minimum is often $1,500 or sometimes $500 depending on the bank. If you had that amount sitting untouched, the fee would disappear. But since you don't, you're paying simply to keep your account active. The account itself is basic, checking or savings. Interest earned is almost nothing, around 0.01% annually. Meanwhile, the bank uses those same deposits to lend money at much higher rates. This difference is how banking operates. At your level, you're simply not large enough for them to compete for your business. If you apply for a credit card, you may be offered a secured card. This requires you to deposit your own money as collateral. In simple terms, you're lending the bank your own funds so they can lend them back to you and potentially charge interest. This is standard practice when building credit from the bottom. Service at this level isn't aggressive, it's indifferent. Staff are polite, the app works. Customer service exists, but it's scripted, delayed, and limited. There is no relationship here, only transactions. You exist in the system as a small number, and small numbers are handled automatically. Level 3, stable income. Something shifts, not dramatically, but meaningfully. You now have consistent income, maybe $3,000 or more per month, arriving regularly. The system detects this change, not emotionally, not personally, but through patterns. Your account behavior moves from inconsistent to stable, and that triggers a different response. Now, real credit card offers start appearing. Not secured cards, but standard cards with limits of $2,000 or more. Interest rates remain high due to limited credit history, but access is finally open. You can apply for small loans and get approved. For example, a $5,000 loan for an emergency might be processed within a couple of days. It's not perfect, but it works. For the first time, the system responds in a way that feels functional. Fees may also disappear if your direct deposit meets the bank's requirements. This change feels bigger than it is because earlier you were paying just to hold your money. Now you're keeping it without extra cost. At this stage, you're a recognized customer. The bank sees value in retaining you through card usage, loan interest, and growing deposits. But the relationship is still transactional. You matter, but only as long as you generate revenue. Level 4, growing savings. Consistency starts to show results. You've built savings, maybe $15,000 to $20,000, and investments alongside it. You pay your credit card balances in full, avoiding interest entirely. From the bank's perspective, your profile has changed significantly. You're now low risk and reliable. Credit limits increase automatically. Loan interest rates improve. If you take a loan, it costs less. Not because of preference, but because your risk profile has improved. This is where the system begins to work in your favor. Lower costs mean you keep more money. Keeping more money allows faster growth. The advantage compounds quietly over time. You're no longer just a user. You're becoming valuable. Level 5, high savings and assets. With assets above $150,000, your experience changes again. Customer service becomes faster. Support staff have more authority. Issues are resolved more efficiently because the people handling them can actually make decisions. Sometimes you're assigned a dedicated banker. This introduces a more personal layer of service, someone who knows your account and communicates directly. The relationship is still business driven, but it's more attentive. You also gain access to better financial products, premium credit cards, investment opportunities, and pre-approved offers. The bank begins to think long-term about your value. You're no longer just maintaining an account. You're part of their future revenue strategy. Level 6, high net worth. At around $500,000 to $1 million in assets, banking becomes a service rather than a place. Wealth management enters the picture. This includes financial planning, investment advice, and broader strategies for managing money. The experience becomes personalized. You're asked about goals, timelines, and long-term plans. Decisions are faster, processes are smoother, access is immediate. You're no longer treated as a typical customer. You're treated as an asset to the institution. Level 7, very high net worth. Above $5 million, access expands significantly. You begin to see products and opportunities not available publicly. Loan terms improve dramatically. Investment options become more exclusive. You're supported by specialists rather than generalists. The rules that apply to others begin to shift in your favor, not by breaking them, but by applying flexibility where possible. The system adapts around you. Level 8, ultra wealthy. At this level, banking becomes fully customized. You work with a private banker whose focus is entirely on a small group of clients. Decisions are faster, processes are tailored, and services are designed specifically for your needs. Nothing is standard. Rates are negotiated, access is expanded, restrictions are minimized. The system that once operated automatically now operates personally. You are no longer just a client. You are a relationship the institution prioritizes and protects. And that difference changes everything.